Right now, your money is probably sitting in a bank account and quietly losing value to inflation every single month. In the next 10 minutes, I'll give you the exact roadmap to go from zero to invested as a European. No US brokerage, no complicated jargon, just 5 clear steps start to finish. Let's build it. Hello, I'm Wealthy in Europe. Welcome to the channel. Last time, we found the European version of the S&P 500, the UCITS ETF. Today is the natural next step, how to actually own it, from having nothing invested to being fully set up. Here's the whole journey. Quick note before we start, this is educational information only, not financial advice. Always do your own research and due diligence before investing your money. But first, 30 seconds on why any of this matters. Money left sitting in a bank account doesn't stay still, it slowly shrinks. With inflation at even 2 or 3% a year, €100 today quietly becomes worth less every year that passes. Investing flips that. When you own a piece of the world's biggest companies, your money can grow with them. And thanks to compounding, your growth starts earning its own growth. Here's the power of it. If you invested €200 a month for 30 years, and it averaged around 7% a year, roughly the long-run historical average, though never guaranteed, you'd put in about €72,000 of your own money and could end up with well over 200,000. That gap is compounding doing the heavy lifting. That's why we start today. Milestone 0, the foundation. Before you invest a single euro, 2 things come first. 1, clear any high-interest debt, like credit cards. No investment reliably beats 20% interest, so paying that off is a guaranteed return. 2, build a small emergency fund, roughly 3 to 6 months of expenses, in an instant access savings account. That's your safety cushion, so you're never forced to sell your investments at the worst possible moment. And here's the fear this kills. Do I need to be rich to invest? No. You don't invest money you'll need next month. You invest money you won't touch for years. Once your foundation is in place, everything after this is the fun part. Milestone 1, choose a broker. A broker is simply the app or platform that lets you buy your investments. But not all are equal, so here's your safety checklist. First, it must be regulated in the EU. That means your assets are held separately from the broker's own money, and you're covered by an investor compensation scheme up to at least €20,000 if the broker itself fails. Important, that protects you from the broker going bust, not from markets going up and down. Second, low or zero fees. Third, it offers UCITS ETFs, the European funds we covered last time. And fourth, it's actually available in your country. One extra tip. Pick a broker that also offers free recurring savings plans, because we'll use exactly that in the final step. And steer clear of anything promising guaranteed returns or pushing you to trade constantly. That's a red flag, not a feature. Now the big fear, is it really safe to put my money in an app? This is exactly why regulated matters. A regulated broker keeps your investments in your name, ring-fenced, even if the company disappears. Across much of Europe, examples people use are Trade Republic, Trading 212, or Interactive Brokers. And to be clear, those are examples, not recommendations. Availability and fees vary by country, so check what's offered where you live. Milestone 2, open and fund your account. Opening takes about 10 minutes. You'll verify your identity with your ID or passport. That's a legal step called Know Your Customer, and it's completely normal. Then you connect your bank account and move some money in, usually with a standard SEPA transfer. And the question everyone asks here, how much do I need to start? Almost nothing. Many brokers, like Trade Republic or Trading 212, let you begin with as little as €1, using fractional investing. You buy a slice of a fund instead of a whole share, so you can genuinely start small and learn as you go. Milestone 3, pick your ETF. This is where last week's video pays off. Remember, you can't buy the US S&P 500 fund like VOO here, but you can buy the exact same index through a European UCITS version, which is the same fund as SXR8, just listed in euros, or Vanguard's VUAA. All of them track the S&P 500 and cost around 0.07% a year. Quick word on that fee, the TER, 0.07% means the fund takes just €7 a year for every 10,000 you hold, taken automatically so you never see a bill, and lower is better because small fees add up over decades. Also look for a large fund, many billions in size, which simply means it's well established and unlikely to be closed. Then, two quick choices. Pick an accumulating version which reinvests dividends for you automatically, and you're set. And if you'd rather own the whole planet in a single fund instead of just the US, an all-world UCITS ETF like Vanguard's VWCE does exactly that. Same idea, one ticker, the entire global market. The fear here is choice paralysis. Which one do I buy? You don't need 10 funds. For most beginners, one diversified UCITS ETF is genuinely enough. Milestone 4, automate it. This is the step that quietly does the heavy lifting. Instead of buying manually and trying to guess the perfect moment, set up a recurring monthly investment. Most European brokers offer these savings plans for free. Every month, the same amount buys into your fund automatically, and this kills the scariest fear of all. What if I invest right before a crash? When you buy automatically every month, sometimes you buy high, sometimes low, it averages out over time, and you stop trying to time a market nobody can time. You just keep showing up. That consistency plus time is what actually builds wealth. Before we wrap, 3 quick things not to do. 1. Don't waste time hunting for a broker that sneaks you the US VOO. You don't need it, the European version does the same job. 2. Don't try to time the market. Waiting for the perfect dip usually costs more than it saves. And 3. Don't check your portfolio every single day. This is a decade-long game, not a scoreboard. Set it up well, then let it run. The investors who do best are usually the ones who do the least after setting up. Let's put the whole thing together with a quick example. And to be clear, this is illustrative, not advice. Meet Maria. She's 28, she's got €2,000 saved and about 200 a month left over. Milestone 0, she keeps 3 months of expenses as an emergency fund and clears a small credit card balance first. Milestone 1, she picks a regulated low-cost broker that's available in her country and offers free savings plans. Milestone 2, she opens the account in about 10 minutes, verifies her ID, and moves in €50 to start because she doesn't need thousands. Milestone 3, she buys an accumulating S&P 500 UCITS ETF, so her dividends reinvest automatically. And milestone 4, she sets a €200 monthly savings plan and turns on automatic investing. That's it. From here, Maria just lives her life, while every month her money quietly buys a little more of the world's biggest companies. She's not trying to get rich overnight, she's letting time and consistency do the work. And that is exactly what going from zero to invested actually looks like. So, that's the whole roadmap. Milestone 0, clear high-interest debt and build an emergency fund. 1. Choose a regulated low-cost broker that's available to you. 2. Open your account and fund it. You can start with as little as €1. 3. Pick your UCITS ETF, the S&P 500, or a whole world fund. And 4. Automate a monthly investment and let time do the work. That's 0 to invested. Screenshot this checklist if it helps. And once more, because it matters, this is educational information only, not financial advice. Always do your own research before you invest. Thanks so much for watching, and I'll see you in the next video.